We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Stefan Holzberger, Chief Rating Officer for AM Best. Stefan, welcome.
Thank you, Richard.
So Stefan, today we hosted the AM Best market briefing for the Rendezvous. What were the main messages?
Yeah, so I think the main message from our standpoint at AM Best is capitalization for the market is resilient. There is a significant amount of excess capital despite some of the mark-to-market losses on the unrealized side, despite some of the CAT activity over the last few years, and on top of that, the kind of share buybacks and dividend policies of the global reinsurers. Despite all those actions, we do see the market as significantly capitalized. And one of the things that we really wanted to point out in this session is that the amount of capacity that's available in the reinsurance market is not necessarily the same amount of capital and capacity that's been deployed. So there's dry powder, and if you shift over to the current market dynamics of very strong pricing, tightened terms and conditions, which are really driving today an improvement in underwriting results, and we expect that to continue in the future. Those sorts of activities, I think, are much more what the market has needed to see over the last several years, and it has really culminated in 2023 in terms of a much more favorable environment for the reinsurance sector from a return standpoint. And that's been necessary because of the lackluster returns over several years. I think the investors backing the reinsurance segment are saying, you need to start improving, you need to start meeting or exceeding your cost of capital, or we're going to look for other avenues to invest in.
So those are robust messages to be bringing here. Tell us a bit about the market dynamics that sit behind those messages.
Right, so as I mentioned, it's really been about the returns that have fallen short. The market has needed to set itself up to be able to achieve a reasonable rate of return, satisfy the investors who would be willing to continue to support the market on a going forward basis. I think one of the things that we're seeing at AM Best, take the US market as an example, where the reinsurance segment has in many respects ceased providing the kind of income statement protection primary insurance companies have been used to. The attachment points have gone up, the retentions and co-participations on the primary side have gone up, and what we're seeing as a result of that, with the additional frequency and severity of events, particularly in the second quarter of this year, but it's really something we expect will continue to challenge the primary market with the secondary perils causing so much kind of underwriting loss on a quarter-by-quarter basis. The reinsurers have kind of stepped away from that protection, and we understand the rationale behind that, right? The reinsurers need to be able to achieve a reasonable return, and the amount of losses paid on that sort of layer in the program has just made profitability unsustainable from the reinsurance standpoint. But what that means for the primary sector is a lot more volatility. And if you look at private stock, mutual, regional companies, some of these organizations, unfortunately, have been subjected to a frequency of rather severe events, particularly, again, back to those secondary perils. So the difficulty will be, the reinsurers are meant to act as a partner for their primary companies. The primary companies that don't have the financial flexibility, perhaps don't have that geographical footprint, that diversification to handle these localized events, those companies are coming under strain from a rating standpoint, and it'll be interesting to see how those organizations find a relief valve to protect their balance sheets where the reinsurers have really stepped back.
Stefan, thank you very much indeed for joining us.
Thank you.
For AM Best TV, I'm Richard Banks.